Let's talk whole versus term life insurance Canada. Let me start with reviewing term insurance, some of the pros and cons, and then let's turn our attention to whole life insurance. At the conclusion, I will share my thoughts on which may be best in your situation. Term insurance is by its nature temporary. It provides coverage for a period of time, normally from periods of 5 years up to age 100. It is like renting a home, if you wish, renting an apartment, or I guess leasing a car. You have use of that vehicle or home or apartment for the period of time you are renting it for. So it is an expense play. And in most situations, if you're looking for an apartment, yes, there are certain things you're looking for, but of course, if you're given an opportunity to rent the same apartment, you're going to try to probably navigate to the option that is the lowest expense. There is some additional risk that you may not be aware of. If you're an insurance company offering insurance and you're the lowest provider, well, why are you the lowest provider? Is that because of profitability? So you try to gain additional customers through a lower premium. They have to have the financial wherewithal to be able to pay out a claim. Term insurance does provide coverage for the lowest initial premium. And again, most people, if they're tight for cash flow, that's one thing they're going to consider. They want to get as much coverage as they can. And if cash flow is an issue, definitely I'm all for buying term insurance. Probably most of my clients do have term insurance, so definitely is nothing wrong with it. However, it is interesting that it is the most profitable insurance plan to insurers because only 2% of all term insurance claims pay out a death benefit. Insurers love it because it's cash flow for them. They just love it. Whole life by its nature is really permanent coverage, where with term insurance it provided coverage from say 5 years up to age 100. Whole life really is term to 100, but it's not just a level term to 100, it's an increasing term to 100. Because of that, it's very difficult to compare term and whole life. It is an asset, you own it, and so going back to our analogy before about apartment or home or vehicle, you have the opportunity to either rent it or you have the opportunity to own it. Whole life is an opportunity to own it. As such, it's an asset. And further, it's considered a safe asset because there is no risk. If you want to compare it to real estate generally is fairly stable, but there are times where the market value of your home may actually drop. In comparison, whole life insurance is a safe asset in that the values always increase, and whole life has a cash value. We'll talk about that in a moment, but a death benefit is guaranteed. In comparison to real estate, definitely life insurance is considered the safest, most liquid asset in history and remains so. Whole life insurance provides a level premium, so it's a little bit different than term insurance. Every, say, 10 years, the premium is going to increase. With whole life, the premium stays the same all the way through the duration of your coverage. In order for them to do that, the premium you're going to pay for whole life definitely will be higher than what the premium would be for, say, a term 10, because what they're doing, they're providing really coverage through to age 100. So in order to offer a level premium all the way through to age 100, obviously the premium has to be higher, and it is. Whole life insurance, even though it's a higher initial premium, it does provide the lowest long-term premium, if you wish, compared to term insurance. If you went with a term to 100 versus let's say a whole life, the whole life premium over that period of time will be lower than the term. Because you're paying the higher premium that you're paying over and above what you pay for term insurance, what happens to that? Well, that goes into what they call cash value. And this cash value forms a reserve that the insurance company has to have in order to meet requirements to pay out a death benefit at some point, either in the near term or in the future. So this cash value you have access to. Now, the insurance company, I guess, didn't have to provide this cash value to you. They could just keep it. But this cash value is a reserve. And guess what? If you end up deciding to cash your policy in, this cash value, as opposed to keeping it, they normally will return it to you. You have this cash value that you do have access to. We'll talk about that in a moment. This cash value is also tax exempt, which is why some of the wealthy people in the world actually also own whole life insurance, because it is very tax effective. However, whole life insurance is not an investment. They end up comparing it to something like the stock market. Well, the stock market is like comparing apples to oranges, because the stock market has risk. Whole life insurance has basically no risk. So it's really not a fair comparison. However, the actuaries, in terms of doing their job, they have to manage the premiums on deposit and the investments that those premiums are invested in. They have to do that very wisely. And they've done it so well that the growth of whole life insurance cash value is actually a very decent return. I actually have a client in Ontario who is a dentist. He's had a policy for over 30 years, and I took a look at how well his cash value growth has grown and compared that to the stock market, expecting the stock market would do better, but I was very pleasantly surprised to find out that was not the case. The cash value in his policy was almost identical to what the stock market would have provided. And of course, stock market, you have to account for the additional risk, where the whole life really has virtually no risk. The return is very decent in a whole life insurance plan, definitely better than what you would get in a bank account. The return is also consistent. Every year, the cash value increases. You can't say the same thing for the stock market. Part of the return is also guaranteed. The actuaries have to build that in. That's part of the model. So part of the cash value is guaranteed. Part depends upon dividends. The regulators will tell us that you got to make sure people understand that dividends are not guaranteed. Well, I guess that's true until they're paid, because I view insurance companies that have paid out dividends for well over 100 years, even through wars and depressions, as almost a guarantee. So once a dividend is paid, as it has been every year for over 100 years, it also then becomes guaranteed. Some people would actually call whole life insurance, I guess, the original no limit TFSA. Those who are not aware of TFSA, that's a tax-free savings account. Because it's tax exempt, all the money will grow. You also have tax-free access to it also if you structure it properly. Compare the return on the whole life insurance, considering the risk. There is something called risk-adjusted return. You will find that the best financial vehicle available in the market, you're looking to get the highest risk-adjusted return, actually is whole life insurance. Whole life insurance also provides what they call preferred creditor protection, something else to definitely consider. It also provides guaranteed borrowing. Most people, we've been conditioned that if we want to borrow money, well, we'll just go to the bank and we'll borrow it. We got to jump through the hoops there at the bank to qualify for it. Credit score, lots of application pages to fill out, and that kind of thing. For anyone who's had a difficult financial period of time, you know that banks are not your rainy day friend. What's nice about the whole life insurance is that this cash value that builds up in the plan is available to be borrowed without jumping through the hoops to borrow money at the bank. Yes, you are limited to the amount of money that's available there, and it's usually 90% of the cash value you have access to, but no questions asked. From people who are looking to gain more control back from the banks, the more money you've accumulated in cash value in whole life insurance, that's great. We have some clients who have actually accumulated so much money that they can hold their own mortgage now. Why would you deal with the bank when you don't have to? Related to that, when you borrow money from the bank, who gets the profitability? Well, of course, it's the banks. The banks get all the loan interest that you are paying. When you borrow from yourself, who gets the loan interest? Well, of course, it's you. So this is what we call becoming your own banker. Some people have heard the concept called infinite banking concept. Again, that's just a concept how you can become your own banker. It's basically privatized banking, but you can be your own banker. To do privatized banking, you need some kind of pot of money. Well, the whole life insurance is that pot of money. When you're your own banker, it's the only way you can recover loan interest because you end up paying it to yourself. So who is the whole life insurance best for? Well, it really is best for people who have a desire for savings, who've done some research, and also have surplus funds. Whole life insurance is the most secure liquid asset in the world. So if you like what you've been seeing so far, definitely please subscribe to our channel, like this video. That would definitely greatly be appreciated. So lastly, as to which form of insurance would really be best for you, well, again, it really depends upon your situation. It's probably one of the most misunderstood products available in the financial marketplace. In the right situation, it's great. That's why a lot of the most wealthy people in the world have whole life insurance, and they actually use concepts like the infinite banking concept. they've done their homework. The Rockefellers, that's part of their family strategy, where they're always buying whole life insurance policies on every member of the family. There's lots of stories out there that wealthy people, for example, Walt Disney, Ray Kroc at McDonald's, and there's countless many others have also used their whole life insurance policy. And if they had not had it, they may not have been able to get loans from the banks to build their success empires. So definitely some considerations there.